Okay.
Good afternoon, everyone. We're just waiting for a few more people to join, and then we'll start today's webinar. Okay, there's still a few more people coming in, but I will start my introduction. Good afternoon, everyone. Welcome to today's Strategic Risk in partnership with AXA XL webinar on ESG and Sustainability Risk. I am Trevor Trahan. I am the APAC correspondent for Strategic Risk based in South Korea. Today's webinar is going to explore some of the drivers towards embracing ESG frameworks. There is a growing focus on responsibilities in relation to environmental and transition risk. Many organisations are on this journey already, and we can expect risk managers to play a truly pivotal role on the success of this process. To discuss that and much more, today we will first be hearing from Mark Houghton, Head of Specialty for AXA XL's Asia business. Based in Singapore, Mark focuses on cross-border trade and investment into emerging markets. Secondly, we will hear from Max Lee, CEO and co-founder of Pantus, which provides companies with AI-enabled carbon management software solutions and access to green financing and investments. Just to let you know, today's session is being recorded. We will also be leaving plenty of time for questions, and we strongly encourage your contributions during this session. Please use the chat function to leave your questions for our speakers at any point during the session. With that, I will pass to Mark to open today's webinar. Thank you, Mark.
Thanks, Trevor, and thanks, Max, for joining this session. And yeah, very pleased that AXA XL can sponsor this today. So thanks, everyone, for joining. I can see there's more people filtering into the session, so we appreciate your time. We won't make it too laborious. Hopefully what we present today is really interesting. I'm going to start off by just sharing my screen and going through a short presentation just to set a bit of the context about ESG as to how I personally see it, and also some of the challenges and journeys that we're on at AXA XL. And then we'll pass over to Max to provide a bit more detail, and then we'll leave a good 30 to 40 minutes for Q&A at the end of it. So we'll just start showing my screen. If anyone's got any problems with seeing it, just shout out and I will I'll fix it. But hopefully everyone can see my screen in a big old share screen format. Trevor, can you see that? Can you give me a thumbs up or something, mate? Yep, all good. Okay, I'll just try and find a little pointer as well, just in case we can see things. Yeah, cool. Okay, so yeah, so we're talking about sustainability and ESG and sustainability risk today. Lots to cover. I'm just going to kick it off. And just when I was putting this together, I think one of the things which came to my mind, and I think some people will resonate with this as well, is when we've talked about ESG in the past, it's looked a little bit like this. The E is very big, the S part is kind of people get it and they're not sure about it, and then the G, they kind of just add it on the end because they're not sure if it fits there or not. And I think over the journey over the last perhaps 5 to 10 years, the ESG has become much more balanced and equal, and we're starting to see it as a composite direction and a way forward for many companies and institutions and governments in particular. So we've been through that transition ourselves, where environment was the key factor which we focused on, and in the last 5 years or so, we've really started to see the social aspects and the governance parts become in greater focus, much more levelized than it was before. In practice, what are we talking about? Just as a quick overview, the environmental aspects are what the impact is of a company on the environment. And that's very obvious when we talk about climate change and reducing waste and emission, natural resources, preservation, etc. The social aspect is a little bit harder because I think when we talk about social, and it can be used in very different contexts within your own organization or how your organization impacts with the community. But social is about how a company can improve its social impact both within ourselves and within the organization and across society at large. That includes things like CSR programs and other interaction with the supply chain. And the governance part looks at the firm's structure and composition, and this part looks at things like diversity and inclusion, board balance, you know, how people within the organization are coordinating, etc. It becomes a much more composite governance structure than perhaps we give credit to. And as I said, the ESG part to me is becoming more levelized than that has in the past. So where did it all begin? I thought I'd just go back a little bit in time, and back in 1861, you know, this guy here, you can see in the middle of the screen, John Tyndall, he was the first person to actually investigate greenhouse gas emissions and to actually set up this thing called a spectrophotometer, which looked at absorption of carbon dioxide and water, right? And that was the first real analysis about where, you know, the greenhouse effect was coming from. And then throughout the last 150 or so years, it's become much more, we've got a better understanding about it. We've looked at holes in the ozone layer, and we've started to understand a bit more about human impact on the planet and society. And so if we think about that from 1861, this chart goes back to 800,000 BC, which is probably a little bit before most of us were born. And this really just shows us what we're all being told and what we can see, and that is that atmospheric CO2 concentrations, carbon dioxide in the atmosphere, are rising, and they've risen very quickly over the last 100 years, which is a very, very small part of history in terms of the life of this planet. But over time, we've also seen a very steady and gradual trend line through there, which, if we look further at annual CO2 emissions by the world, and if we try and let's pick out 1861 here, which was about here, where my red little laser pen is. I hope you can see that. At that time, when John Tyndall was working on his first experiments, you know, greenhouse gas emissions and carbon dioxide levels were very low compared to where we see them today, over 25 or 30 billion tons per annum of emissions. This is huge, right? And a lot of that came from developed economies. You can see US, European Union, etc., through the Industrial Revolution, and more recently through the recent extension of mining investment. We've seen that, plus also the emerging markets like China and India starting to add a huge amount of carbon dioxide into the atmosphere. So the environmental part is very visible, and you know, the impact of that is quite real, and we've seen this through the scientific research. This chart is from NASA. They talk about this as the baseline and the actual global warming levels, so where they're seeing temperature anomalies against the baseline, and starting to see this come through. The peak point here at 2020 is starting to become quite concerning, and we've seen over the last 20 years and more, you know, various actions taken by governments and companies to try and help limit this, which is where we are now with our net zero initiatives that are still starting to come through. Of course, the impact isn't necessarily even, and this is averages between 1951 to 1980. And if you look at where that climate impact has had the most effect, we can see it very much around the polar caps and in cooler climates around Russia and China, and even across Europe. Interestingly, the USA is on a bit of a cold patch. It's reducing in climate, but this may have changed since 2019, but the impacts are very real. And then if we think about going one step further beyond the environmental, and then we think about the social impacts that we have, you know, that's not flout, that's actually drought and flood. You know, looking at these two images, we see quite a contrast in how things are perhaps evolving in the world. Recent floods in Pakistan, increase in natural catastrophes. You know, ESG is driving a lot of these issues and trying to tackle them at the same time. And other challenges that the world has, you know, population growth is huge. It's something which we really struggle with. Poverty eradication is continuing to be something which we talk about. Add into that things around inclusion and diversity, social inclusion, work inclusion. There's a lot that we need to think about when we put this concept of ESG out. In addition to that, we see a lot of migration, planet migration, whether it's through refugee migration or deliberate migration for job prospects, as many of us have. You know, that also has a serious impact on the social acclimation and inclusion across the world. And one thing, just, you know, I think one thing that occurred to me is we talk about ESG as a very recent concept, but we can see now from years gone past that, you know, we've had a lot of people look at environmental considerations. We've had, here's a good quote from Franklin Roosevelt about creating a more inclusive society, creating a country in which no one was left out. This was before World War II. So for the last 70 or 80 years, this concept, people in high places have been talking about these issues and also struggling with them. Mahatma Gandhi said something similar about Our ability to reach unity and diversity will be the beauty and the test of our civilization. So, thinking back through time as to where these issues and elements have come from gives us a view into the future about the challenges we face, because this transition and the ESG framework that we're pushing through at the moment, of course, is very rapid, and people want us to move quickly and make big investments and put big numbers around. But for the practical day-to-day application, we can see that people have struggled with that. And if we look at a bit about climate change and sustainable development, this chart's from a research paper from global, a couple of students who are doing some research on university leadership, and they mapped out where we are and what we've been doing. And we can see, from 1972 or even 68, we've got Declaration of Human Environment. The first World Climate Conference happened in 1979, pushing forward Intergovernmental Panel on Climate Change, 1988, the Kyoto Protocol in 97, the UN Millennium Development Goals in 2000, which addressed a lot of issues around poverty, to where we are now with our Paris Agreement and our UN Sustainable Development Goals. So this pathway is pretty small when you think back to the chart I showed you going back to 800,000 BC. But in the context of human evolution, ESG is very real, and we're making very, very strong efforts as a globe and as in each respective country to push forward and to take the next step. And we can see this slide, I think, hopefully shows a little bit of that as we've started out, the Kyoto Protocol, which is probably the most obvious place to start around environmental concerns, has evolved and been more clarified and refined by, on the top right here is the Millennium Development Goals, which were put in place, which talked about, eradicating poverty and hunger, child mortality, to where we are now with the 17 Sustainable Development Goals from the United Nations. A lot more granularity, a lot more dedication and specification, which allows companies to get involved with these areas more concretely, and it also gives us a better roadmap as to where we're going. And the next step, this net zero initiative through the banking alliances, insurance companies, and I was looking up a bit of information about the net zero, and it turns out that many local community councils in the UK and other places have their own net zero initiatives. So it's becoming quite the trend. That said, I think at the same time when we talk about ESG, the gentleman here is Stuart Kirk. He used to work for HSBC as their head of responsible investing. He stood up at the FT Moral Money conference and he said that he doesn't not believe in ESG, but he said perhaps the risks that we're being confronted with aren't as real or aren't as immediate as perhaps we think they are, and that this is going to take a lot longer for us to solve than just trying to be addressed as of today, right? I'm giving all this background, I think, in some context to kind of think about what is sustainability, right? And then what is sustainability risk? And then how do we, in the insurance industry and also with respect to risk managers, how do we manage that, right? Peak oil, yes or no? Flood, famine, how do we control these issues which potentially impact our business through supply chains or through our own CSR activities, and protect the investments that have been made into our companies and by our companies? And for the risk managers, we go back to those concepts, that the simple solutions. We look at environmental. This isn't an easy pathway to follow. Navigating the issues around renewable energy or greenhouse gas emissions and water management are quite complicated in their own right. Complicating that further is the social aspects around inclusion, diversity, human rights, local communities, health and safety, and then the governance aspects, which we as responsible investors of capital and I guess institutions who are working towards a better world need to hold ourselves to in terms of ethics, stakeholder management, social inclusion, working with our local communities. So the ESG framework of where we've been and the history about what's happening in the world and leading to the point where we as risk managers have to look at this, I think becomes quite concerning. But how do we respond, I guess, is probably the question I'd put out. And I think we have the basic toolkits to do that. We have the processes, we have the procedures, we know how to manage risk. Managing these risks in a different way and as they evolve is quite important because we haven't seen them, we haven't been able to test a lot of these risks, and we're still trying to get to grips with how they actually impact our businesses and the communities in which we operate. So, responding with prevention, preparedness, recoveries, response plans, suitable risk management frameworks which help us manage and control situations to the best of our ability is the tried and tested process we have, and it still applies here. But obviously the issues and the outcomes potentially are slightly different. Hence, we need to think about this in a bit more detail. And so for me, yeah, just again, what does it all mean for us? I think, we can see here, we estimate that around $350 trillion of capital is needed. This is from Baringa and BlackRock investment companies. Lots into power and transport sectors, as you can see, the chart on the right showing a breakdown of where they think that's going to go. And this is really targeted at a 1.5 degree centigrade increase scenario, right? The one thing that it says to me, apart from the risk management complications that we have and using the tools that we have already to work with, it's just going to cost us a hell of a lot of money, right? And I think that's something which, as an organization, we need to be very aware of, because there can be a lot of traps, there can be a lot of wasted money. And one of the issues that I really think about a lot is the investments we make today. At this point in time, we have no ability to know whether they're going to have the right impact on our ESG frameworks and our ESG principles going forward in 10 or 15 years. So, a lot to think of there, but hopefully that's just set a little bit of a scene for what's to come and some of the questions that might raise. I'll hand back to Trevor now to pass across to Max, and we can carry on the conversation. So I'll just stop sharing.
Brilliant. Thank you so much, Mark. That was a very rich and if at times slightly sobering introduction to the discussion today. So I'm going to invite Max to come forward now and present. Thank you, Max.
Okay, let me share my screen. Okay, can you guys see the screen, Mark or Trevor?
Yep, can.
Okay, great. Okay, so to start, it's a great introduction, so thank you. My name is Max Lee. I'm the CEO and co-founder of Pantas. We actually provide carbon management and climate due diligence solution, and I'm also the founding chairman of the Carbon Accounting Risk chapter between the Risk and Insurance Management Association of Singapore. So risk management is a topic dear to my heart, as I was doing that every day when I was a portfolio manager at a hedge fund bank in New York before venturing into the startup scene. So today I'm going to spend a little bit more time, given that Mark has did a great intro. So I'll go in a little bit more about climate investment risk. How do we manage this risk? And for our bankers, insurance professional, risk manager here, how do you know that the bond, the stock you have in your portfolio is really green? How can you ensure that your organization do not shows up on the news for greenwashing? How do you ensure that you're not investing or financing company that engage in greenwashing, regardless of whether the act is intentional or not? Because when that happens, usually people shoot first and ask question later. So let's just go to the next slide. Okay, so carbon accounting is really complex. It involves extensive data collection. Based on a survey by BCG, companies estimate 30 to 40% error rate in their emission measurement. And however, sustainable finance market has grown 100-fold globally in the last decade, and ESG investing in emerging market have expanded across region, type, and sector in the past 3 years. And I want to focus a little bit more on this sustainability linked bond. So we're seeing a massive growth in this new kind of instrument, sustainability linked bond, that tie interest rate or the debt cost to measurable and verifiable KPIs, such as the reduction in carbon emission. So sustainability linked bond make up only a small portion of the sustainable bond market, but they have grown extremely fast, soaring to more than 170 billion since they were introduced to the market in September 2019. So if you're wondering why sustainability linked bond, SLB, sounds so familiar, it's most likely because you've been reading, hearing about them on the news lately, especially for our participants from Singapore. So Sembcorp industry, it's recently being accused of greenwashing because of the recent transaction to sell and then finance its own coal plant in India to avoid paying penalty interest of extra 25 basis points on its 975 million Singapore dollar bond, sustainability linked bond. I'm not here to opine on whether this sales and self-finance transaction constitute greenwashing or not, but the fact of the matter is they are on the headline and they're taking a reputational hit on this. So there are growing concerns that green capital is being deployed based on misleading information. We all know that we need a lot of money to get to net zero, to get to 1.5 degrees warming, but how do we do that? So companies globally are receiving increased scrutiny on greenwashing. Like I said, how can you ensure your organization is really green? How do you ensure your investment is green? And how do we conduct proper due diligence on this? So we want to think we are kind of an expert on this. We have developed a solution for banks and institutional investors to conduct climate due diligence on their lending and investment portfolio. So to test the effectiveness of a solution, we conduct our analysis on publicly disclosed climate report of listed companies. We share our due diligence result with regulator, investor, and journalists on a no-name basis. And back in July, the journalists at the Business Times managed to identify one of this company that committed error. We identified and confronted them directly. So this company subsequently revised all their reporting, corrected every errors that we discovered in their sustainability report. But the point is, as the risk manager of this company, they should prevent making this mistake instead of getting show out on newspaper and then come and revise all their green credentials. So based on BCG survey again, more than 90% of the company measure and report their emission inaccurately. We focus on the part in Asia Pac. So our solution mesh identified the following common and materials errors. This error resulted in reported emission on the company's sustainability report and a report that are off by as much as, well, as low as 20% to as much as 10,000%. Yes, you hear it right, 10,000%. This common error exclude emission from companies' own vehicle, apply incorrect or outdated emission factors, include negative emissions, use incorrect methods, etc. So a lot of people ask, does it make a difference if this company obtained a third-party assurance on their climate report, on their sustainability report? So our answer is most of this company, especially in this part of the world, that make material reporting error receive third-party assurance from assurance provider based in UK, US, Norway, India, Singapore, Malaysia, Thailand, etc. So what I'm trying to say here is third-party assurance doesn't guarantee error-free climate reporting. I know this might seem shocking for some of you here, so please reach out to us after this if you wish to learn more. The thing is, if you do this, if you report something that's incorrect in your annual report, in US, SEC will go after you. In Europe, you'll get into trouble. Unfortunately, in this part of the world, that is not the case because regulation is still very nascent and as everybody only start to report recently, so we're seeing a lot of inaccurate report, a lot of exaggerating claim about net zero, etc. I mean, if you do not report most of your emissions, you can get to net zero very easily. So in the next few slides, I'm just going to show you some real-world case study of error committed by publicly listed company in their climate report. All this company received third-party assurance on their climate report. All the data and information shown here was taken from the company's annual report or sustainability report. Given that there's no standardized format or way in reporting carbon emission, especially in this part of the world, we train our analysts to actually capture and input the relevant data into the software, and then the software will indicate the error made and the potential issue to investigate. So the first one is Top Glove that was called out by Top Glove is the world's largest glove manufacturer listed in Singapore and Malaysia. They were the one who were called out by the Business Times analysts. So they included a bunch of stuff in their calculation, including biomass, which is incorrect. They also do not do complete reporting. They do not include any petrol or diesel consumption in their Scope 1 calculation, despite being a manufacturer of with a large fleet of mobile vehicles such as car, truck, forklift, etc. They also have negative emission because they claim that by recycling, they suck up carbon, so they're allowed to do negative, which of course they are not allowed. So they show on newspaper, So the next thing is in the most recent, their fiscal year end is August. So after they show up newspaper, they had to revise all their emission report and then recalculate all this number and literally just agreeing with everything that we mentioned about them getting wrong. So, and this is a big company with, you know, third-party assurance, and it occurred. Well, luckily, this company didn't issue any sustainability-linked bond. Imagine if they were, and you were the one who invested in them, how do you want to explain to your shareholder or to your investor? So the second company, this company B, is a listed oil and gas service provider. They reported a 17% increase in their electricity in fiscal year 2022, and only 1% increase in their Scope 2 emission. We grew a little bit suspicious on their number, so we utilized our software to reverse engineer their calculation and figure out that the company has underreported their Scope 2 emission by around 20%. And like I said, some of this company actually have sustainability-linked bond available. Company C is a pharmaceutical company with operation across Asia. Our software able to show that the Scope 2 emission from its electricity consumption in West Malaysia alone exceed its total reported Scope 1 and 2 emission from its operation across Asia. So for 2021, it reported a total Scope 1 and 2 emission of 22.8 thousand metric tons across its global operation, but its Scope 2 emission for its operation in West Malaysia had generated 24.3 metric tons. So the number just doesn't make sense. But this number have been reported in their sustainability report, has been verified by third party as well. Company D, listed infrastructure company operating mainly in Malaysia and Singapore, over-reported its Scope 2 emission by 80%. We use our software, it just shows that the company doesn't seem to know what they are reporting. But this is all the stuff that we see on listed company. But what I'm trying to show here is tip of the iceberg, as we cannot conduct due diligence on climate information that has not been publicly disclosed or insufficiently disclosed. If we can find error in this publicly disclosed report, imagine how many errors are being made behind the scene, and imagine how much investment that's going into all this company claiming to be green, etc., without real number to substantiate it. So I hope my short presentation set the stage for our next, for our following discussion. Thank you. I'm going to stop sharing.
Brilliant. Excellent. Thank you, Max. That was great. A very important issue and very important, highlighting how data literacy and the ability to kind of go down to that level to find out the truth is really important on this area. So please do leave your questions. It's a great opportunity to ask exactly what you'd like to know from Mark and Max. While we're waiting for those questions to come through, I've got some of my own. I might start with you, Mark, go back to you, Mark, and some of this has come up, but I wonder if you had any more details or something that hasn't been mentioned so far in terms of what are some of the main drivers to embracing ESG?
Yeah, so I mean, let's start with Max's point around some of the commercial financing that's happening. I think at the moment this is becoming a very key driver for organizations to show their credentials in a very public way, how they raise money through bank lending or the capital markets. You know, being responsible as an investor and attracting capital is really important in today's market, and it's never been more critical at this point in time. It's very difficult to raise capital at the moment. So the advent and the increase, I guess, in sensitivity by fund managers and investment funds looking at ESG and actually tailoring their portfolios, AXA as a group has very strong ESG credentials and very tight guidelines around how we invest our money. So that capital raising and attracting investment dollars from many different competing entities is really, really important. I think the other drivers, you know, if you think about the human elements, it's to do with staffing and workforce. The inclusion and diversity is really important from a social standpoint. The governance, board diversity, women in positions of seniority and leadership, I think is a real key one that people look for and strive for. With many corporations around the world having a very strong stance on percentage of women in certain leadership positions. Brand and reputation, I think, is probably the most undeniable concern for many people, because if you look at where things can go wrong, if you have a problem on a brand or an ESG challenge, whether it's an E or S or a G, it can hit the headlines very quickly, whether it's a board dispute or something to do with gender diversity or inclusion with disability or anything to do with those challenges. Even it could be supply chain challenges through how you engage with your supply chain and who is involved with your supply chain, whether there's sanctioned individuals or potential politically exposed persons that we don't necessarily have, or otherwise just untoward companies that you may accidentally be engaged with. That brand and reputation risk is what you trade on, and that drives customers away. It drives all sorts of different consequences in the capital markets and the lending arrangements as well. You see it from very quickly how people can distance themselves from either athletes or musicians or other people who very quickly go down the wrong path of social inclusion or otherwise diversity, and they'll be distanced very quickly. So for a corporation, seeing them be involved or engaged with companies or organizations or individuals that compromise their social standing, I think is really key. So that to me is very strong. The last one, which I think is really important, is, as an organization, I think most organizations in the world, I'd say by and large, want to have a strong community engagement. They want to be a part of their community. They want to support the people and the workforce that they promote, but they also need to be giving back. And I think going with the brand and reputation risk, I think that community engagement is really key. If people don't, or if companies don't adhere to that and recognize it, they can be very quickly turned over and ousted from a local community, and that will have huge problems for their reputation. So those are just a few. I didn't touch on environmental because I think those are quite obvious, but
I think I want to add on as regulations. So as Asia is part of a huge global supply chain, and those are exports overseas, the main issue is like forced labor. Your goods might be stopped at custom, or issue about even the ESG issue becoming very important for our clients that's exporting, especially to Euro and US. So just to add on that, and with the upcoming CBAM, carbon border adjustment mechanism, so the cross-border carbon tax is real. So you do not want to show up as miscalculating and getting a fine, etc. So yeah.
Sure. I mean, something we've been thinking about a lot recently. I mean, the risk manager plate is often quite full, but right now it's very full, and a large number of external risks and emerging risks around the global economy, what we're facing on that, interest rates, inflation, conflicts and tensions, geopolitical issues. The question that we've just received is that, is there a danger that near-term issues such as the economy and inflation could distract from ESG objectives? I mean, how do we stay focused on ESG?
Do you want to kick that one off, Max? Or do you want to start?
Mark, would you like to?
I'll go ahead then. Well, in terms of, I think from climate perspective, I think I'll just talk about my domain expertise. Climate perspective, I think the recent situation, the war, inflation, etc., let people realize energy security. So I think, and that's kind of impact. You're seeing renewed investment on renewables, and the Inflation Reduction Act, which is kind of like a climate bill in US, so we know. And I see, instead of distracting people from ESG, I think it make people focus at least on the E side. And you see a lot more money coming into the sector. More countries are making pledges with money to decarbonize, to remove coal plant, etc. So I don't think we're seeing slowing down, at least on the E side. And then I'll kick the rest to Mark.
Interesting question. I think a lot of the changes that I think we just talked about ESG wise, they're structural, they're not momentary. So if I think about point in time changes, we're not making a point in time change which then dissipates. It's actually structural changes to the way we think about social issues around corporate governance issues, and also around the way we engage and interact with the environment. So I think if you think about this as being part of the long-term infrastructure, then yes, I think there is a threat that you can be pulled away from ESG or perhaps been twisted or pushed in different directions. But at the same time, the economic conditions, the inflationary landscape is always going to be there. It's never going to go away. And if nothing else, like Max just alluded to, I think those issues and those challenges are creating opportunities which people can go after. They are creating innovation to get around these issues. They're creating different ways to think about optimizing capital and shareholder return. So I think if we think of this as a structural shift, I don't see these as being complex or difficult issues to tackle, especially if you put these concerns and considerations in place to be a longer term outcome, which I think for most companies, how we structure our board, how we look at our employment practices, how we work with our supply chain, how we work with our environmental partners, that's a long-term play. It's not a short-term proposal. So I think that's how I would see it. Would make it a big deal at the moment. It's a risk we have to manage, but it's not something which should necessarily distract from ESG.
Sure. Okay, good to hear. So Max, this is a question for you from the audience. I know there's interesting case studies, particularly the sustainable reports had third-party validation. The question is, are there any standards or officially accepted emission factor?
So to do carbon accounting, there's a globally accepted standard. Unlike normal accounting, where each country, each region have different, slightly different method for carbon accounting, everybody's using the greenhouse gas protocol. So that standardized it, so make it much easier. So that's first thing. And in terms of reporting as well, that there is no standardized format, but there's still numbers that Scope 1, when you mention Scope 1, everybody knows what Scope 1 is. And then when you mention emission factors, there are relevant emission factors. Those are science-based. Even if it differ, it will differ 20%. Like maybe EPA has certain emission factor that they use versus the European versus DEFRA, which is the UK emission factor, but they are around the same. So there's, so the number will not differ by much. So that's the first thing. And then the main difference is in emission factor for electricity, and that's based on region. So, but again, that it's clear what emission factor you need to be using. So for people who know how to do it, they will find the correct one, and it's clear. It's never, so the error doesn't come because I use one emission factor that is more. It's usually not because of that. It's just either you use the wrong one. It's not because you use the different standard. Hopefully that answered the question.
Great. And Mark, there's a question for you as well from the audience. I mean, these risks are not static. Would the insurer expect to have a continuous engagement from the insured side, or is this a one-time assessment at the time of underwriting the insurance policy?
Yeah, thanks, Jan, for that question. It's interesting. I think they are not static. You're dead right. And I think I think as an insurance company, we want to understand the customer's mindset. We want to understand what they're doing and how they're acting, and if there's things that we can help with. We have our own ESG challenges. We can share thoughts and exchange views about how we approach our challenges internally, and also some of the products that may be available to help out. So I think at the point of underwriting, yes, it's a very important consideration. And then as we go through the journey, because it is a journey, I think it's continuous engagement as and when required by the company to calibrate their understanding of what these risks are and how they would respond to them. I think at the same time, there's no perfect answer, because a lot of the risks we don't have clear data on. We don't have formulated data from 100 years of history, and we're trying to kind of build this on the fly. So I think collaboration is good for everyone to help understand or grow their understanding about what the risks are and how we actually grow together, I guess. So yeah, it would be a time of assessment, and then I'd say it's probably more of a continuous engagement as and when needed by the customer. I don't think we want to be imposing ourselves onto them all the time, but it's certainly a process which we need to go through together.
Sure, and I'm just going to stay with you, Mark, on this next question, because it's relevant to what we were talking about there. Just had a question, what sort of support can the insurance industry offer risk managers as we embark on our transition journeys?
Yeah, so if you think about this, I mean, insurance companies become let me go back one step. So I came from a different industry into the insurance market, and one of the things I noticed very quickly was the level of technical information that sits within an insurance company is actually very impressive. Whether it's the guy that does the horses or the satellites or the engineers that look at the offshore wind farms, the technical expertise that sit within insurance companies is very vast, as well as their risk management and risk engineering capabilities. So I think in terms of going through this transition journey, we're trying to get ahead of it as quick as we can, but we're only learning from field practice and field evidence, which comes from engagement and dialogue with customers, which is what Jan was alluding to before. So, for us, being available to be a trusted partner, someone who can give advice about risk and how they can manage things on our best understanding from what we've seen in other case studies. I think looking at Scope 2 and Scope 3 emissions, evolving our mindset and thinking about how that works is really important to try and understand together what this looks like and how we can evolve our thinking. Our job and our responsibility as an insurance company is to evolve our models and our understanding of these risks as quick as we can to help transfer some of the risks that are unable to be accepted by the private sector or the government sector into the insurance market. And that needs to happen pretty quickly. So we're up against time. We're striving for innovation, but it's hard to push forward when we don't have that information to do it. So we are in a similar position to our customers, but we need to get ahead of it quicker than perhaps they can using other benchmarks. The other part, which I think, the other reason I think insurance companies do end up being a good risk partner and perhaps a good risk advisory function is because there just isn't enough people. Right? There's not enough people with expertise in this specific area. You think about what's evolved over the years. I mean, there's thousands of jobs on, job.com for sustainability and ESG. There's millions of people who don't yet have the diverse body of knowledge to understand these issues from a science-based outcome perspective, and to be able to put that into application in a practical world. So I think, being able to rely upon organizations that have those bodies of knowledge that are pushing really hard to develop them and grow them, I think is really important.
Right. So the next question I was sort of hoping to ask is that as we're seeing organizations seek to transition to net zero, what are some of the risk management challenges that they're going to face? And I might start with you, Max, on that one.
Okay, so I think the first step for a company that want to transition net zero, the first thing is just to get a good hold of your Scope 1, Scope 2, Scope 3. So before we even talk about offset using carbon credit or renewable energy certificate for those who are more sophisticated, it's tough. Like Mark said, there are companies are hiring like crazy for this kind of roles because carbon accounting is a complex, it's a complex topic, and there's a lot of resources need to be put in to start the calculation process. Scope 1 and 2 is relatively easy, but Scope 3 is your supply chain, and how do you know whether your, let's say I'm Apple. Apple is different. You can control your supply chain much better. But let's say you're just a manufacturer in US and you buy certain parts from Asia. How do you calculate that? And does your supplier even do that to calculate for you? So it starts to get a little bit harder, and that's why you're seeing a lot of tech company going net zero, because for tech companies it's much easier. You are not buying a lot of raw materials. You outsource most of your production anyway. But so the first step, the first challenge is actually to understand the scope. Like, where are you? The bigger the company you are, the harder it is. And then once that is done, the second step is get the proper help and pledge with the organization like CDP or SBTI, Science-Based Target Initiative, to set the targets. And then after that, the net zero is the offsets. How do you use carbon credit or other type of carbon storage technology to reduce your carbon emission? It's a process. So whenever I see a company that says I'm going to be net zero in like 5 years, there are even investment company that says that, I was like, those are like huge red flag from greenwashing. And what we realize is a lot of companies, they started by making the big claim, we're going to be net zero, and then they work backwards. Like, okay, now how do we do that? We just make a huge announcement, and that's the risk, because people, once you make the announcement, you get the publicity you want, and then the next thing is how you're going to deliver. So we are seeing that, especially in this part of the world where this kind of carbon accounting is still very new, and but it's a journey for a lot of companies. But I think the first step is, you know, do what you mean, because you do not want to show up on the newspaper as greenwashing. That's, you know, that's, as risk manager, we all know that that's the #1 thing to avoid, right? So
I think just on what Max said, the transparency is key. I think I mentioned data availability before, like getting reliable data and information which allows you to make decisions is really important. I think some of the other challenges that I see, reliance upon third parties, whether that's your suppliers, customers, advisors, data providers, right? Relying on people with third-party information that are trying to help you along the journey, but at the same time, maybe giving you metrics which aren't useful. I think that's a real key part, because as risk managers, we're making decisions upon information that's presented to us and we acquire. Making sure we've got accurate information and reliable information is key. The other part which I think is really interesting to kind of put in our minds is the ability and willingness to adapt, right? I think we're going to fail a lot in the next 10 years with ESG application because we're going to get it wrong. And I think we have to be able to fail fast, in the words of, you know, can't remember who said it, was it some other famous guy? But if we're going to fail fast and adjust quickly and try and find a way through that, rather than wallowing in problems and trying to dig yourself out of it. I think just be willing to step back and go, okay, we got that one wrong, let's move on. There's a tendency in risk management to try and capture all the risks and quantify them, make sure they work well, etc. But for this pool of risks that we're looking at, I think we're going to have to be a bit more adaptable and really perhaps drop our expectations about getting this right from the start.
Yeah, to echo that, so even under GHG protocol, they allow you to revise your number, etc. If you find error, etc., change your base year, not going to get punished for that. You're going to get punished, you know, on the media, for example, if you deliberately or due to, you know, negligence that you decided not to report certain things to show a better number. I think that's kind of, I think if you crack like that, it's dark. Like, you know, if you intend to cheat, then, you know, it's, if you get found out, it's very easy to identify. It's hard to give you an example. I can give many examples, but I think as risk manager, you will know, like, you know, some of the stuff it's easier to tell because the intention is there to portray, due to pressure to portray something better than it is, and then that might backfire. And that's what we're seeing in a lot of companies in this part. Everybody's rushing to report without proper data, proper knowledge, and then the next thing is you show a newspaper.
Yeah, great. So we've got around 13 minutes left. If anyone had any further questions that I hope to get in, we've still got a few topics we'd like to discuss, but if you've got any questions yourself, please do put them in the chat. For the next question, Mark, I'll sort of go back to you and wanted to sort of talk a little bit more about the role of the risk manager and anything that we haven't covered on that front really, but in particular, what do you see as the role of the risk manager when it comes to sustainability risk?
Yeah, I think, like I said before, I think the key aspects of that are trying to be ahead of the curve and filling yourself with enough information. So being aware of the risks and being aware of what's out there. This is an evolving space, so just being up to speed and up to date with what's happening and the information available is very key. There are a lot of Donald Rumsfeld unknown unknowns because, you know, we're coming to a point where we have to be adaptable, recognize that testing new risk management tools that may not have historical experience attached to it, what worked in the past for other risks may not be applicable to ESG, given the complexities of some of those issues. I don't think the basic premise of risk management is changing fundamentally. Yes, they're going to be further and far more at the forefront of what's happening and making sure that their company can abide by, you know, the changes that are coming down the pipeline. So monitoring, measuring, taking action, doing those things are kind of common practice. I think they need to continue. And I think just being, you know, a gatekeeper for their organizations on a lot of these issues would be very, very helpful because sometimes, as many companies will no doubt attest, ESG is a big subject and trying to put your arms around it and confine it and actually have outcomes from it is quite important. An interesting example, a person I know who works in the financial sector, I won't say for who or where, was taken on in the role of the head of ESG. And they said to me, when they were leaving their role as the head of ESG, I said, why are you leaving? And they said, well, they wanted me to originate ESG business, They wanted me to write an ESG framework, and they wanted me to talk to the regulator about our ESG compliance, right? So that's 3 distinct roles. So from a risk management standpoint, being able to separate out the different responsibilities the company has around ESG is also critically important to make sure that resources are being applied in the right way and that there's no undue risk being taken through regulatory means or other issues as well.
Max, did you have anything to add on that?
No, I think Mark covered it really well. I mean, be informed and keep abreast of all this development. I think that's important. No, I think Mark's covered pretty well. I think.
Sure. Okay. For my next question, I might stay with you then, Max. I wanted to ask a little bit about benchmarking. I mean, you both presented data in a way that we're seeing where we're progressing in Mark's case, and Max, in your case, seeing that there's the data isn't always as it appears in terms of claims. What are some of the challenges when it comes to benchmarking progress over time, and particularly when it comes to non-financial data?
I'll take that then. I think for this part of the world, well, I mean this part, I mean Asia, it's very difficult because most companies are starting on their journey. The data is not, like, for example, we go to our client, they said, how are we performing versus our peer? I was like, we can compare you to your peers in US and Europe, but that's like comparing apple to oranges. It's not going to work. There is lack of data, and mandatory reporting is not in Asia. It's not haven't started yet. Singapore starting next year. So I mean, I discount Australia started way earlier, but I mean just Asia. It's not started yet. So most companies are reporting on voluntary basis, and the data there is just not good enough for us to do much benchmarking. So we hope that with the mandatory reporting coming into place in some of the country in Asia, that we can start to do a more meaningful benchmarking. But currently, unfortunately, benchmarking it's very difficult because we are benchmarking the Asian companies to the Europeans and US. So yeah.
I think, yeah, just add on to that with respect to non-financial or qualitative data. I think there's a lot of benchmarks that will become available. There's a lot of case studies that can be shared and evolved through this process. So I don't doubt that will become more relevant. And I'm sure, like Max mentioned, the financial or the actual real data which is being reported, I think will also become quite relevant. But for now, I think in terms of the qualitative aspects, there's so much talk. It's trying to work out what that filtration needs to be to get to something which is tangible for your purpose. And I think when you look at different organizations and their approach to what they do, certainly around how they approach sustainable financing, whether it's green bonds, blue bonds, loans, sustainability linked loans, any of that financial aspect, there's plenty of non-financial data around which people can use to help benchmark what they're doing and how they're doing it. When it comes to the qualitative assessments of the impact that we're trying to have through our ESG practices, that is way evolving. And like I said before, well, I may have said before, you know, at the moment we're being pushed and driven to give discounts and benefits and concessions for people that are working on ESG basis and trying to be sustainable, etc. But we don't know if what they're doing is going to work. So I think there is a real pressing need to make that qualitative information available, whether it's, you know, quantitative, like Max talked about, whether it's through indices which look at, you know, seawater salinity or, you know, groundwater erosion, whatever it happens to be. Whatever the financial metrics are, combined with qualitative factors that we can track over time, that's really, really critical to try and help understand whether the actual financial kind of incentives that people are giving out now to customers and to borrowers, etc., is actually going to work, because they may say they're going to do it, but they may not, or they may be less effective. And I think the challenge is trying to give incentives, financial or otherwise, now for things that haven't yet happened in the future. That's a real critical path which we need to get better at.
I just want to add that, well, we talked a lot about the problems, but I think this will be solved over time. And solved over time because people are reporting, mandatory regulations coming in, and we are working with central bank across with different central banks across Asia to come up with programs to literally quantify some of this work that we have been doing. So put numbers behind all this so that to give investors a little bit more confidence that the money they put in on this thing actually works. Or actually doesn't work, we don't know, but at least we are starting the process of collecting it and to show some impact. So I think it's a field that is evolving very quickly, but I do believe that in the next at least 12, 24 months, we'll get a lot more data that will help us to guide us in this path.
Sure. The next thing I wanted to ask about, I mean, risk management isn't just about threats and managing threats. It's also about seizing opportunities and fulfilling business objectives through risk management. Risk managers are great at seeing these opportunities and helping businesses sort of fulfill them. When it comes to the climate transition and the broader sustainability objectives, what are the opportunities out there for companies to seize and the role that risk managers can play on that? Mark, if I could start with you on that one.
Sure. When if you think about this component in its different part, I think the company and the risk managers can certainly internally and thinking about how they control their governance aspects be very, very across that. And I think those key metrics are what will drive opportunity for firms, because good corporate governance is something which responsible investors are looking more and more to, and there is a much stronger push for people to be responsible investors. So we're kind of funneling all of our money into a responsible investing framework, and we need to have stronger governance, which from a risk manager's viewpoint becomes quite not an easy win, but it's a win they can really pick up and take forward. In terms of the social aspects, I think again there's internal aspects to that and there's external. If I think about the supply chain and how people can benefit from being a part of bigger projects that are being pushed forward, then to me, being close to government agencies who at the moment are the ones that are pushing very hard on ESG initiatives and really talking about climate finance and climate projects, sustainability. I think the mobilization of capital right now is coming from a very, very strong push from the United Nations and from other government agencies. The biggest challenge we have, and this is perhaps the opportunity we see, is for companies to actually put viable projects together. Speaking to someone from a multilateral bank, or multilateral development bank recently, they said the biggest challenge they have is they just don't have enough bankable projects. So being close to that money, talking to the capital providers and being able to find ways to help structure deals and structure business opportunities so that you can capture that governmental funding which is coming out, I think will be critical. And that's a great opportunity because the government agencies need ideas, right? They're not solving this for us. They're putting the capital on the table to say, okay, we've got this program, we want to put X amount of money towards it. You guys come and show me what you can do. So I'd like to think those opportunities will exist, and looking at some of the new technologies that are around and available for, especially on the environmental side, that can be fostered and kind of implemented will be quite interesting as well.
Okay, I'll add a little bit on that part as well. So in terms of the government, the intergovernment support, etc., going with the solution to them. In fact, I had a call earlier today with a multinational company risk manager. Surprisingly, I usually get meetings with chief sustainability officer, not risk manager, but for whatever reason, the risk manager set up a meeting. So we talk about, so they want to know how they can take advantage of this. And we just of last week, the Central Bank of Malaysia announced a partnership with us on greening the supply chain program. And we're telling them that this is an opportunity. The government is putting in money. We created the program. We just need participants, and there are already participants in the company. But a lot of risk managers taking like, oh, let's just wait and see. I mean, there's limited spot. If you wait and see, other people will do it. So that's so that's and there's a lot of opportunity. And another opportunity we mentioned is like CBAM, the cross-border adjustment mechanism, the EU carbon border tax, and like that's the opportunity. As a risk manager, you need to flag it and term it as an opportunity, because if your company start the reporting earlier, you gain advantage in those markets. So I think as much as people think it as a risk or a threat, but it is an opportunity at the same time.
Great. Right. So we've just got about 30 seconds left, but I'm going to just quickly press you both for just some closing remarks, really, sort of 20-30 seconds, just surmising what you think is the major messages from today. So Mark, if I could start with you, please.
20 seconds, God, I don't know what to say anymore. Yeah, mate, just I think be adaptable, keep an open mind. We're all in this together. Unfortunately, we have no choice but to try and find a path through it. Whether it's right or wrong, I don't know. We're going to find out in 50 or 100 years, so my kids can send me a postcard one day. But, I think we have to be optimistic and have a vision about what we can do to make an impact on the ESG framework. And I think risk managers are a key part of that. We certainly, as we said before, look to partner with them and help them through this journey. It's something we collectively don't know. So going into a new space where we're trying to understand how these risks will respond. Some of them are old, a lot of them are new. We really need to be working together and collaboratively to find ways to make it work. And as I said before, there are opportunities out there. I think you have to be alive to them, responsive and pragmatic, that some things won't work. So yeah, I think we've got a long way to go in this path, I'm sure. Next 50 or 100 years gives us a bit of time to switch careers if we need to.
Thank you, Mark. And Max?
I think I echo what Mark just said. I think this is a risk and also opportunity at the same time. There's actually a lot of opportunity, like I said, a lot of capital that's coming into this sector, ESG, especially climate. And you just need to be adaptable and stay aware and talk to more people. You see that it's literally a lot of very, very attractive opportunity available out there. And then, but of course, as a risk manager, we need to be mindful of how to mean what you say, and especially when it comes to making the ESG claims, net zero, etc. And I think the last thing you want is your organization show up on the news like company X do whatever. And I think the basic principle is just mean what you say. And I think that should be the driving forces. If you really think that you're going to make net zero, then say it's fine, but make sure you have the plan, etc. to follow through with it. That's it.
Right.
Thank you.
Yeah. So, well, thank you so much, Mark. Thank you so much, Max. There were some great insights today. This is a discussion that's going to be happening long term, hopefully with some more positive graphs and the directions they're pointing in at the start. Thank you to everyone who attended, and thank you to AXA XL for today's sponsorship to make the discussion possible. Greatly appreciated. There will be a special report written based on today's insights, so you'll have a record of what we've discussed. That will be available on the StrategicRISK website sometime into the future. But for now, thank you, Mark. Thank you, Max. Thank you for everyone.